It's Brian Preston, the money guy.
Now let's talk about a few other key differences that are worth noting. The first we have already alluded to. We said that we agree that credit card debt is bad. However, we disagree very much on credit card usage. Dave and Ramsey Solutions would take the stance you should not use a credit card anyway, anyhow, no, not never. We operate under the assumption that credit card usage is fine and can actually be a benefit so long as you're using it responsibly.
And I want to be clear about this. Dave really doesn't use credit cards.
He really does not.
We know enough people that
deal.
work in that operation that they even have the way they do their expenses. It's legit. He's actually eating his home cooking too. And I know George as well, and George doesn't use credit cards whatsoever. But I think I would be a hypocrite. And I've walked around and I've interviewed all of our primary advisors, asking them whether they're using debit cards or they're using credit cards. And then we've interviewed and we've actually surveyed our actually millionaire clients. And here's what we found. 97% of our millionaires use credit cards. I use credit cards. Bo uses credit cards. Now, like I said, we completely agree with Dave and George in the fact that we pay off our credit cards every month. So credit card debt is bad, no-go land. However, I kind of dig me some rewards. I mean, right now I've got a business that I had Reby helping me out on something, and I didn't have a credit card to put in so they could automatically bill me. And so I'm having to go through all these hoops and activity with my bank to set up a debit card so we can quickly get that set up. It's a pain. Yeah. And I'm just telling you, credit cards do make it easier to travel. You get that insurance protection for, because you go on websites, you don't know what you're buying, but it's okay with a credit card because it's other people's money.
Exactly right. Another big difference that we have are on auto purchases and auto loans. Dave and Ramsey Solutions is the camp that you don't ever have an auto loan. You need to pay cash. And in order to pay cash, you probably ought to be buying used cars. We fall into a different camp. We think that auto loans are okay so long as you follow very specific rules to make sure you're staying inside the guardrails.
Well, once again, Dave came up with the baby steps, which came out in the 90s. And look, y'all, I think I've shared with enough of you guys. My dad lost his job in his mid-40s, and it was about this time. This is actually it was the late 80s. And he did the whole beater strategy. We bought a 1978 Chrysler LeBaron for $1,000, drove it for 5 years, and then sold it for $1,200 because my dad was that type of guy who was very handy, kind of that shade tree mechanic. But that's not who I am. And I was more worried about, for all my non-handy people, you need reliable transportation to get to that real wealth builder, which is that JOB. And that's what a beater's just not going to work. We don't live in a time now where you can look in the newspaper and find $1,000, $2,000 cars that are reliable. You just need more. And that's where we do differ in the fact that I know I didn't buy my first new car until I was 32, but I did buy used cars where I was putting down 20%, financing them less than 3 years, and making sure those payments didn't exceed 8% of my gross income, because that was keeping my eyes in check and my ego in check from exceeding what my wallet could afford. And I also always kept in mind, I wanted my car payment to be less, not more, less than what I was investing every month. So I actually have some army of dollar bills building that wealth in the background, so one day I'd be truly financially independent.
Another area where we're a little bit different, but the gap is closed a little bit, is on what you need to do for a home down payment. Historically, Dave and Ramsey Solutions have always said 20% down, 20% down, 20% down. But with this new housing market, with how difficult it is to get into homes and with the rise in prices, they have brought that down a little bit, down to 5 to 10% for a house down payment. We actually give you even a little more latitude. For first-time home purchasers, we think it's okay if you only put down 3 to 5%, just so that you can get on the home ownership wagon. Now, you still have to make sure you adhere to not letting your housing costs exceed more than 25% of your gross income. But if you can do that with a 3 to 5% down payment, we are okay with you putting less down on your first home. Now, if you're upgrading or moving to a second home or changing your lifestyle, on subsequent homes, you got to hit the 20%. It is non-negotiable. But on first homes, as low as 3 to 5% is okay.
Yeah, I look at this as somewhat of a money guy echo, and the fact that we were very early on the scene to telling people, look, that first home, you just got to get on the home ownership train. So 3 to 5% is effective. We went and interviewed all of our primary advisors. I know what you did on your first house. I know what I did. I would be a hypocrite if I didn't share a system that actually reflected what I'd done for myself, which was I put down 3 to 5% on my first home. We give you the same grace so that you can get into the home ownership arena and then make sure that you're still being disciplined on that second home. This is, look, this fit in nicely. We didn't have to adjust our system when inflation kicked in. Our system was already kind of all weather because it was already built in because we've dealt with this with clients and ourselves to build success.
Another thing when it comes to home ownership that we think we differ on a little bit is on a home mortgage. Historically, Dave says and Ramsey Solutions says you need a 15-year mortgage. We recognize for a lot of folks starting out on the wealth building journey, 15 years is hard. It's going to limit what you will be able to afford. And with housing prices going up, that's a more difficult thing. And you may be asking, well, does it matter? What's the impact of a 15-year versus a 30-year? We put together a really quick case study to show you this. Let's assume that you have a $100,000 income. And let's assume that both two people, one that's doing a 15-year mortgage and one that's doing a 30-year mortgage, both are going to cap out at spending 25% of gross income on their housing costs. Let's assume on the 15-year mortgage, right now you get a slightly better rate of 6% on a 15-year mortgage, where on the 30-year mortgage, you actually have an interest rate of 6.5%. Those are pulled from current rates available. When you look at the 15-year, if you were to follow this and stay inside the affordability, you'd be able to afford a home that's right under $260,000. However, if you were to stretch it out, same monthly payment, but now you do a 30-year mortgage, you can actually afford a home that's almost $350,000. By stretching it to 30 years instead of 15, you actually open up the population of homes you can buy and increase your purchasing power by 34%. For someone who's young and new and early on in their journey, that can be huge. That can be the difference in you getting to live in the community where you work and where you spend your time and having to find a job somewhere else in some other community because that's where the housing is affordable.
And I also want to remind people, because I got caught in this. I got it so excited in my second home that I refinanced into a 15-year mortgage. But then when I was trying to move to my current home, I got kind of pinched a little bit because I had that higher cash, payment element with the 15-year versus the 30, and I needed more flexibility. And then what squeezed me was the fact that 30-year could very easily become a 15-year. Yes, there's a 0.5% premium from doing a 30-year over a 15-year, but there's nothing that says you can't prepay that 30-year mortgage in 15 years. Matter of fact, once you're in a 30-year, because you maybe needed the 30-year to let you have the grace to get a bigger home for your growing family, when times are better, because fast forward 4 years into this home, maybe you've gotten a promotion, you've gotten a pay raise, you can look at it and go, you know what? Why don't I calculate? And I want to go back to paying this house off in 12 years and 15 years. There's nothing that says that you can't transform that 30-year mortgage into a 15-year mortgage. You just get a little more grace and flexibility. And we just always want to share that so you know what your options are.
And then another big difference between Ramsey's view and our view is on investing. Dave likes actively managed mutual funds. He subscribes to this 4-fund portfolio all across the equity spectrum. We differ. We like really low-cost, affordable index funds. We don't think that the goal of investing should be to beat the market. It should be to be in the market, to be participating. So index funds are a fantastic solution for investing, in our opinion.
And the good news is there's a deep dive on this. We don't have enough time to go into all the specifics on this show, but we did do in a complete show a deep dive on Dave Ramsey's investment advice. Financial Advisors React. We love putting that out there. Go check it out, and I think you'll see. We really highlight the differences. But I do want to close this out in a very positive way, in the fact that when we had Dave on our show, I was very impressed at the when he was talking about, because I tried to ask him difference between 15%, 25%, his thoughts on real estate versus ours. And he said something that kind of touched me. He was like, look, you guys are doing great stuff. You're moving people in the right direction. And he's like, and we are too. I mean, he was, and I kind of closed the show with that positivity. And I want to do the same thing today, is that it comes full circle back to know yourself. If you're a person, you're watching our content, but you're sitting there with credit card debt. You're sitting there with you're struggling with the basics of just investing. You can't save $3, much less 25%. you probably do need a good kick in the gut to say, I need to do a little shock in my financial life to get myself out of debt. You probably need to focus on the basics and the behavioral stuff, and that's what the baby steps with Ramsey can do.
Sure.
But there is going to come a point, even people who start with that struggle, you usually graduate to the point you go, man, I've gotten to the point where I've had some success. I've gotten some promotions. I need to go a little deeper. I need something that maximizes. Guess what? That's where the financial order of operations fits in. I love that we get to change the world and share all this positivity and really create systems that help you. I love to differentiate the differences because some systems need to be simple for some people and some systems need to be maximizers for others. There's something for everyone. I would just encourage you, go do something to build wealth. Don't wait 3 years. Don't wait 5 years. Don't wait until you feel like you can afford more. Start today on your wealth building journey.